My name is Avnit. I run the quality of earnings and sort of transaction advisory practice, if you will, at a mid-sized CPA consulting firm. So I started the QV practice here about probably 5 years ago now. I was at Deloitte doing QVs and audit. Prior to that, decided to come down to the lower mid-market. This year, we'll probably do anywhere from 50 to 60 transactions across the board. In the last couple of years, our dollar value, enterprise value is very much in that 1 to 10, 1 to 15, a lot of SBA pari passu, a lot of SBA type deals, and a lot of kind of lower mid-market ETA, entrepreneurship through acquisition transactions. We do some higher ones once in a while. We had one this year that was 6.5 million in EBITDA. We did one last year that was kind of north of 10 million in EBITDA, a restructuring one that was 11.5 million in EBITDA. So we do some mid-market deals. We don't always. We like to focus on the ETA space and the lower mid-market. In the lower mid-market, we're probably doing 6 to 7 deals per month, depending on the month. And I was just telling Andy, it's funny, December is usually historically slow, but we had 3 entrepreneurs submit LOIs that got accepted last week. So it's going to be I guess, busy Christmas for us, but it's always a good thing. I say that to say just a brief introduction to our firm. The topic today we're going to be covering is quality of earnings. So me not knowing, I'm sure some of you are familiar with quality of earnings more so than others. Some of you have probably seen reports. Some of you have probably been through the process yourself. If you've submitted an LOI and you've had a deal fail or a deal get to the QV stage and not sort of pass what we do here. So there's always a lot of things to look at when you do a quality of earnings. And honestly, I can probably talk about this for hours and hours. And given our time limit, I'm not going to do that. To Andy's point, what we're going to talk about today is going to be a focus on what's the quality of earnings, why do I need one done in my transaction, and then I want to give you guys real life tangible stories that we've seen this year in terms of deals dying. I think I've got 6 or 7 in these slides, and that's just happened in the last 6 months where we've done a QV and the deals died because of it, either due to what we find, either due to, I'm not going to say fraud, but a miscategorization of EBITDA and sellers' discretionary earnings, which has caused the multiple to drop significantly and caused the deal to die. So in our practice, to give you some high level numbers, I will say probably on around 20% of deals, we see a materially adjusted EBITDA difference from what the seller and the SIM and the broker have provided to what we've provided. So that's 20% that's significantly different. Another 30% that's lower, but still within retrade possibilities and kind of you can still make it work. Another 10 to 15 that's okay, maybe just a little bit off, very close, and then another 10 to 15 that's right on and spot on. So that's anecdotally what we're seeing in the market for fiscal year 25. As the macroeconomic environment tightens and we're seeing things across the board, I can tell you guys in the last 3 months, the amount of deals we've seen with drops in EBITDA, drops in SDE, and sort of weakening revenue numbers, weakening bottom line numbers has increased significantly, more so than last year and more so than the year before that. So as you guys are looking to buy businesses, that's not to say deals are not getting done, they absolutely are. But just be aware of the environment you guys are doing deals in. If you're an e-commerce business, it's so different with the tariffs and everything else that's coming in. If you're a construction-based business, or if you're tied to residential or sort of corporate and commercial construction, it's all different. So I think there's pockets of the economy that are doing quite well, pockets that are struggling a little bit, and pockets which maybe have seen significant rises in multiples and now we're starting to see drops. So that's anecdotally what we're seeing in the market. So I'm going to kind of get into my slides a little bit, get into some QV information, tell you guys a little bit about it. If you have any questions, we'll leave time at the end for questions. But at the same time, if we're talking about a topic and you want to ask a question, feel free to jump in and we'll just tackle them as they come here. All right, awesome. So I talked to you guys a little bit about Tree Walk. I'm going to get into what is financial due diligence and sort of start here. So financial due diligence and quality of earnings, when you guys are buying a company and you submit something, you submit an LOI, IOI, mainly LOI, it gets accepted. The first service provider, or the one you really start to pay money for, is us. And so financial due diligence and quality of earnings comes first before you get into commercial, before you get into legal, Operational, you'll be doing at the same time, either by yourself, just to make sure you can run the business, you're aware of what the business risks are. And then financial is obviously is going to be us taking over the burden from you. Some of our best clients are people that have done this for a living, have worked in investment banking and private equity, and they still hire us to do their QV. And the reason is to say, is not that you can't do it, but when you have a 60-day window, a 45-day window to buy a business, is your best time to go out and tie out all the bank recs and bank statements and ask questions on Rev Rec and all that? Probably not, right? You're probably trying to raise capital. If you're doing SBA, you're trying to work with the SBA loan broker, get your own personal stuff in order. Make sure you hire lawyers, make sure you hire your third-party insurance diligence team and all of that stuff. So financial due diligence is basically a true examine of the EBITDA and SDE. And that's only a part of it, right? There's EBITDA, there's SDE, but then there's other factors like what's my working capital cycle look like? What's my customer concentration look like? What's the customer concentration that I have? What's their customer concentration look like, right? And I'll give you guys another story. And everything I want to talk about today, I want to add in real life stories of what we've seen on QVs, just so you guys understand it a little bit better. We did a QV on a business down south where they were a construction-based business that was very tied to 3 big residential multifamily developers, really. And so my question to the buyer was, listen, your customer concentration is pretty high, but what does their macroeconomic environment look like? If I can reasonably predict that these guys are going to be doing another project over the next 2 years, I can guarantee you're going to have this much revenue. But if there's nothing on the horizon, are they still meeting their targets in terms of getting financing from the market, even with the downturn in real estate across different cities and across different states and counties? So really going a step further in our QV is really what we like to do. We like to identify risks early on, but then dig into those risks, right? Like we did a QV and all of a sudden we seeing, okay, the customer churn is so low, which is amazing. But then all of a sudden their largest customer from 2023 churned through an acquisition this year. Okay, now that's a bit of a risk, right? Because now they've lost 15% of their revenue. Who's going to replace that? And so looking at things like that, looking at the revenue recognition from a technical accounting perspective, are they meeting GAAP? Are they meeting accrual basis? Is there manipulation for fraud or error? Is there room for that? All of that goes into a financial due diligence package. And it's really what makes financial due diligence so important, right? It's that when we talk about the pillars, it's financial reporting oversight. What's their financial statement system look like? And is it accurate? Is there room for mistakes? Every time we assess a company, and first things we ask ourselves, okay, is there an opportunity for mistakes and fraud? Is there incentive for opportunity and fraud? And what are the risks for fraud? Really, 3 areas is where can people make mistakes and where are people going to purposely make mistakes? And so understanding the financial reporting structures is very important. Proof of cash is the first thing we do when we do QV. For those that don't know, proof of cash, anytime you give your QV provider the go ahead, the first thing they're going to do, and if they don't do this, then probably not a very good QV provider. You're going to take the bank statements, you're going to match them with revenue and expenses that the seller has stated. So for example, if your revenue is 10 million, you should have 10 million come into bank account, net of balance sheet movements and AR, net of things like deferred revenue, and at the same time, net of things like bad debt and non-cash expenses. That has to be within reason. Same thing on the expenses side. If you said our expenses are 8 million on your financial statements, we should see 8 million leave the bank, net of movements for PPE, balance sheet movements, those sort of things. So that's where we come in, and that's the first thing we do. Any good QB providers at this point also going to trace to samples. So for example, if we see 10,000 going to the bank account, it looks off, I'm going to say, hey, can I see the invoice support for that? So proof of cash is very like a black and white procedure, if you call it, in the sense that there's no judgment. It's you're doing this and it has to match and it has to be right within a few percentage. If it's not, we have a deal killer in step 1 and phase 1 of the QV. As we go further down the QV, you'll see things like adjusted EBITDA, net working cap margins, stuff I talked about earlier. And now I'm going to kind of go into what that looks like on an actual QV so you can see it. So as we do QV, this is an example of one of our QVs, which we've redacted, and you guys can kind of see in the executive summary here, accounting processes, what we look at from a quality of earnings perspective, net working cap, income statement, and things like appendices that are actual support and are actual supporting schedules for the work that we've conducted. As you go through a QV, it's always important to understand things like the transaction overview, points of interest, highlight what we've noticed in some major things that we're seeing in the business. From their accounting process, remember when I talked about opportunity and basically incentive for risk and fraud, that kind of gets flushed out here. Is there an appropriate segregation of duties? Small businesses likely not. So you just want to make sure you're on top of it and you have a QV provider. And when you're doing your DD, you're really looking at, okay, when I buy the business, what do I need to fix? What can I fix? And what's a risk in this business? As we go through the process, revenue recognition, deferred revenue, there's probably a, I don't know, depending on the business you're in, maybe a 40% chance that this is being done wrong in the deal you're looking at, based off our anecdotal experience. So really understanding if you have a construction business that you're looking at or something that has to do with work in progress, this is very likely going to be wrong. If you've got a deferred revenue component of your business, so you're looking at med spa, subscription-based businesses, you're going to have a deferred revenue component. You're going to want to make sure that that's flushed out because that's going to be a deal killer as well if it's not identified early. So understanding profitability, cost of sales, and the entire accounting process is another part of our QVs and something that we make sure we always do before we get started and really before we do a deep dive in. So now let's look at like a QV itself. So a QV, this is sort of the output you'll see. You'll have a definitional EBITDA, which is your EBITDA or SDE. So again, EBITDA and SDE are two different metrics, and make sure you guys understand the difference when you guys buy a business. One is vastly different than the other. A lot of you, probably 50% of you, maybe more, are going to be buying and looking at businesses that have SDE as the multiple instead of EBITDA. So make sure you understand that, because if you're doing an SDE business, you want to make sure you have replacement salary for owners, things like that. EBITDA should have it normalized. SDE multiples are lower than EBITDA multiples. So make sure you guys understand that and make sure you're looking at it. I mean, it doesn't matter what the business presents at the end of the day, but you as a buyer, what you pay for it and how you think of running the business is vastly different for an SDE business and an EBITDA business. So understanding definitionally what you're looking at. Is it EBITDA? Is it SDE? And is it all make sense in the grand scheme of what I need from a cash flow perspective? Now looking at due diligence adjustments. So this is where we tend to, when we hear the word quality of earnings, this is what we think about. We think about what is our diligence adjusted EBITDA and what are areas where the seller can manipulate this. The seller is going to have an incentive to inflate this as high as possible, because obviously if you're buying a business at 4x, every $1 adjustment in EBITDA is a $4 increase to the seller's pocket. And so it's in the grand scheme of things, in the vice versa contrast, any dollar decrease in EBITDA is going to be a $4 decrease in purchase price. So from our perspective as a QV provider, this is where we really dig in and hone in on finding. So you can see on this sample, there was 18 adjustments. Usually it's not that many. Maybe it's somewhere in the 9 to 10 range on average, give or take, depending on the deal and the business. So this is where we tend to find a vast number of our mistakes and a vast number of our adjustments to an EBITDA number. So giving you guys, I promise, some real life war stories. So what have we seen this year from quality of earnings due diligence adjustments that have led to deals collapsing? I'll give you one to start, and as I go, I'm going to name a few more based off of this EBITDA cycle. So we did a deal last, or maybe 2 weeks ago, where the seller had a $400,000 add back to payroll for somebody that was not working in the business. It was a shareholder. And they said, listen, the shareholder gets paid $400,000 through payroll. They're never here. They're never on site. That's a valid add back. Amazing. Okay. So this company, they do their books and then they give their books at year end to their tax CPA. Great. The tax CPA then makes something called an adjusting entry at year end that the seller was unaware about. So what happens? The $400,000 staff member who was getting paid, the shareholder, you look at the payroll reports, they're in there. You look at the company census report, they're in there. They're in the P&L, perfect. It's a valid add back, right? So you think, what can go wrong? Well, when they give the financial statements to tax accountant reclasses the $400,000 salary from P&L to shareholder distribution. So he takes it out of the profit and loss anyways when he makes his year-end tax return and moves it to shareholder distribution. So it's not an actual payroll item. So what's the impact of that? Well, the sellers added back $400,000 to EBITDA that was never deducted in the first place because the tax accountant had already adjusted for it at year end. So now all of a sudden we had a situation where our EBITDA was inflated by $400,000 because of that. And that's something where if you just looked at the P&L on a monthly basis, if you just looked at the payroll reports and the census reports, you would see the $400,000 salary of that staff member. You would see it as a valid add back. But now we're in a situation where we've done a QV and we've gone through and we measured it against tax returns, and we see this tax returns and the accountant at the tax level doing an adjustment to shareholder distributions and paying it out as distributions. So that's an example of a scenario where, well, $400,000 would have got missed had this company not done a QV, or the buyer had not done a QV. He would have lost out potentially on $2 million because it was about a 4x multiple, right? And so that's a very, very high risk of situations where if you miss a QV, or if a QV provider misses something, where you can end up in a very adverse situation. So that's a deal we worked on a few weeks ago, and that scenario had come up. Another scenario on the same topic of shareholder distributions versus expenses, a lot of times you guys are going to see SIMs that say cash flow. Cash flow is not ST, it is not EBITDA. And you'll see that depending on the broker you're working with, some brokers are great. I'm not going to cast aspersions on all of them, but some are new. And what they're going to do is they're going to go to the seller and say, hey, what's your cash flow? Seller is going to say 200,000. They're going to put 200,000 on their SIM. They're going to add back shareholder distributions. They're going to add back balance sheet withdrawals to their P&L add backs, which is essentially what happened in our case here. That's an example of a real life deal killer, because you're not measuring apples to apples. You have a broker and a seller who are comparing two different things when they're asking for a multiple in the business. So really understanding the difference between the two and getting ahead of it when you guys look at SIMs is very important. So that's a real life deal example that we saw die because of a QV and something we done. Another business, probably 3 weeks ago or maybe 4 weeks ago, we had the call with the seller where their EBITDA had dropped from 2.1 to 1.3 after doing our QV. Two main things: they represented their EBITDA on a cash basis, and they're a construction-based business. So you have two very, very inherent risks in your EBITDA number when you're a construction-based business and you're a cash-based business. This one had both. Once we converted cash to accrual and we appropriately allocated our work in progress in making sure our percentage and completion revenue recognition was accurate, we were off on EBITDA by $800,000. That deal died as well a few weeks ago. So these are two deals in the last month where we've seen EBITDA swings probably more than I've seen all summer and fall that happened just in the last month. And I don't know now if that's going to be indicative of the market moving forward, but I'm telling you, as a QV provider, seeing this happen in the last month, I'm on probably high alert for all of my QVs now, because I'm getting a sense that businesses aren't doing as well across the board, and sellers and brokers are finding creative ways to get the same multiple they've always wanted to get. And so, especially for buying a construction business, or a business that's based off work in progress, or a business that's based off percentage of completion, you're at much higher risk than other businesses for overpaying, essentially due to inappropriate accounting treatment and inappropriate accounting methods. And so from a QV perspective, I'm already worried about that. I'll give you guys another example of a deal we did a few months ago. It's a business that has capital leases. So for those of you who are not familiar with it from an accounting perspective, when you enter into a lease of equipment, you can classify it as capital or operating, especially in private M&A and private companies. Operating leases go through the profit and loss. Capital leases go on the balance sheet. So if you're thinking from an EBITDA and STE perspective, what's more favorable as a seller? As a seller, you want to show your lease as a capital lease because there's no impact to your EBITDA. So you can lease out equipment for, I don't know, $500,000, and there's nothing adversely impacting your EBITDA because you're leasing the equipment as a capital lease. The only thing you're paying on that is sort of your lease payments and your interest, not going through your profit and loss. It's a depreciation item. It goes on your balance sheet. It's an add back with EBITDA. you are in a much better situation doing that than if you had operating leases. From a QOV perspective, this is an area where just because you classify something differently from an accounting perspective, it should have no impact on the valuation of the business. And so this is an example where I told the buyer, I said, listen, their treatment of capital leases is accurate. Fine, I will give them that. But when you buy this business, I promise you, you're going to have to still pay those lease payments on your balance sheet. And so that's real cash leaving your business. And so if you want to pay that multiple and you want to pay on that EBITDA dollar, great. Just know you're going to have to pay for capital leases. You're going to have to pay for capital expenditure as well, similar to what the seller was doing currently. So in your cash flow, as you're looking through your debt service coverage ratio or you're looking through your SBA loan payments, you need to make sure you've got $150,000, because that's what the lease payments were, allocated towards lease payments, because that's money you're never going to see and you're going to be paying every single year in capital expenditure, basically. And so understanding definitionally what the sellers are trying to do, and that's another one we see about a month ago. And so these are three anecdotal ones I've told you about what we've seen in the last month and how it could adversely impact our deal structure and what we're doing. I had a client or a potential client come to me last week, and they talked about a business that had gift cards and a business that had subscription-based models. And I gave them a story about a deal we did. It was a med spa in the Vegas area that sold subscriptions for up to 3 years for people. And they obviously recorded their books on a cash basis because they wanted the best offer for the business. And so you're selling all these 3-year subscriptions, your cash numbers are going to look amazing. But then, okay, well, how are you going to service that? How are you going to service the cost for that? So when we did a deferred revenue adjustment, their EBITDA dropped about, I think, $500,000 to $600,000 in an EBITDA drop because we switched the books from cash to accrual and we backed out deferred revenue. I think deferred revenue in the last 2 years, I've seen more deals die of deferred revenue than probably anything else. It's probably, if not, it's the top 3 deal killer is deferred revenue. Business sellers simply don't understand it. They don't understand why if they take money up front, it's not their money. They don't understand why they need to leave it back. They don't understand why they don't get the EBITDA lift for that. And so if you guys see a business with deferred revenue, right away, I think you should put your sort of blinkers or your antennas up a little bit, because that's a huge area, and an area that we're seeing anecdotally every few months or every few weeks or so, where business buyers and sellers are not aligned on, and they have a different perspective on it. So deferred revenue is a, yeah. So I think Lana just asked an example of deferred revenue. Yeah, absolutely. So yeah, I'll give you one. I was talking with somebody last week, and they're looking to buy a business that sells gift cards. And so gift cards is an interesting one, because if I sell you a gift card for, I think it was a gift card, you have like 6 months to redeem it or something like that. That's an example where I sell you something, okay, $100 to lend, I give you a gift card and you buy it from me. I haven't earned that revenue yet, because that's money you've given me, but I have to provide a future service to earn that revenue. I've just taken money from you. That's not revenue. That's cash, and it's not even my cash. It's restricted cash until A, your gift card is redeemed, or B, your gift card expires. At one of those 2 points in time, I can recognize that revenue and I can put it into my EBITDA. Until that happens, it's not my money. If I sell you a gift card and I refuse to provide you the service, or I close down, or I decide, okay, Delana, you bought a gift card for a dinner, I can't serve you that dinner, I have to give you that money back, right? Or it's not my money. So that's an example of deferred revenue. Another one we see a lot is construction-based businesses, or let's say POs. Before I ship you my product, before you're allowed to place an order, I want 50% deposit. Great. You give me a 50% deposit, and I have to send you, I don't know, a phone, for example. Well, until I send you that phone, that 50% deposit you've given me, it's not my money, because I haven't provided you anything. I can't take that 50% deposit and give you nothing and say it's my money, I've earned that revenue. In order to earn revenue, you have to meet the threshold of providing performance obligations. And so we see it a lot in construction businesses, because they usually have deposits, and they usually have they usually recognize revenue on a step-by-step basis, like based on milestones. And so we see it a lot of construction businesses. And The other risk, so there's a risk of inflated EBITDA. The second risk is if I buy a business and all of a sudden the seller has taken 100% deposits, well, just the seller's taking the deposit, walked away with the money. Who has to perform the service? It's me as the new buyer, right? Like if you've given me a deposit and the seller takes that deposit money and walks away, I have to provide you the service. So not only do I not get the money, not only did I take a hit on the multiple on EBITDA, thirdly, I'm taking a hit because I have to send you this phone or I have to send you this product without receiving any money because you've already paid for it. It's just the previous seller took the money because it was deferred revenue. So deferred revenue is it's a very weary topic, and depending on the type of business you're in, there's different ways it can look like. But basically, it's revenue that's unearned that the seller has sitting as cash, and it takes a few different hits on the QV. Not only do you get hit because your EBITDA drops once we remove it, you get hit because you as a seller can't take that money. It's a cash-free, debt-free deal. But me as a seller, if I'm selling my business, I have to leave my deferred revenue back. Now, this is where negotiations happen. This is where having a QV provider, a deal team, or a lawyer, people on your team that understand it, because there's like 3 different ways you can deal with deferred revenue at close. There's one that's most advantageous to buyers. There's one that's least advantageous to buyers. And so the one that's most advantageous to buyers is the seller leaves all of the deferred revenue back and the buyer gets all that deferred revenue. And then the buyer has to satisfy the costs associated with that revenue because they got all the cash and money. The worst case for buyers is you get no cash and you have to pay for the cost of servicing that revenue. Usually what happens in a QV, or usually what happens in a deal, I say, is it falls somewhere in the middle. The seller and buyer come to an agreement on how they need to leave that money. They need to come to an agreement on where that money is going to go and how it's going to be shared between buyer and seller. So that's where deal structure negotiation becomes a little bit more important, a little bit more value add in that scenario. But it's just something to know that deferred revenue is going to be, and it has been in our case, is one of the highest reasons for deals dying and for real life examples of deals falling apart. And anything with subscriptions beyond a year or beyond 12 months are just a very big red flag for a scenario like that, especially if it's not accounted for early and not accounted for in an appropriate manner. So from a diligence adjusted EBITDA, those are some of the things we look at when we do our quality of earnings and trying to find out our sort of diligence adjusted. And on this topic, another war story I can give you guys for a deal we did a few months ago. The buyer is buying the building and the seller has added back all rent. Amazing. Well, what the seller didn't account for is, okay, who's paying property taxes now? The property taxes before were not on their P&L because they rented, right? So they had the rent in their P&L, they added back all the rent. They did not put a placeholder for property taxes. They did not put a placeholder for electric bills, utilities, and maintenance of the building. So you want to add back all the rent, great, because you're saying, I'm selling my business and you're buying the building, great, I'm adding back all this rent. Well, then you need to put a placeholder for property tax, and you put a placeholder for electric and utilities, and you need to put a placeholder for maintenance of the building. Then you get your real cash flow and your real EBITDA at the bottom. So anytime you got a building coming with a business, it's a little bit trickier. And anytime you have somebody that's selling a business with the building is trickier. So make sure you're accounting for things that just because they were not the seller's reality, they might be your reality moving forward. I don't care really. Sellers always say, this is my EBITDA. And it's like, great, okay, I love that that's your EBITDA. But just because it's your EBITDA doesn't mean it's my EBITDA. As a QV provider and as a buyer, we care about what your EBITDA is. What are your macroeconomic environments? What are your relationships? I look at the seller's EBITDA because that's usually a good proxy of what the business is going to be like for you, but that's not always the case. Insurance is a prime example. We do deals in the construction space all the time. And like I said, your rate for insurance for somebody who's never ran this business might look very different than somebody who's been doing woodworking for 25 years or CNC shop for 25 years. Your insurance is going to be a lot different than theirs. So what's the EBITDA? It's not their insurance added back. It's their insurance added back plus what's going to cost you to get new insurance. So that's a prime example of an area where we see differences, right? And so That's one. Another is potentially, if a lot of times payroll is a big lift. Every time someone buys a business, I promise you, your payroll is going to be higher than the sellers, because the sellers probably all long-term relationships. He's probably not, doesn't need his incentivized staff to say, you as a new buyer, you might have staff that wants to leave. You might need to upkeep some things in order to keep some of your key employees, your general managers of the world, and things like that. So your situation might look way different. Another time where we see this a lot, probably 1 to 2 of you in this room are going to buy a carve-out business, right? Most of you won't, 1 or 2 will. Anytime you do a carve-out, the numbers look way different than what the consolidated ones do for the business. And I will give you guys another example of this. We did a deal this year where the seller was selling a facility. They were doing a carve-out. It was a, sort of a FedEx ground business, if you will. The seller had 1 general manager for 2 locations. Great. He's selling 1 of the locations. He took his 1 general manager, the 1 location was 70% of the revenue, 1 location was 30% of the revenue. He was selling a location that was 30% of the revenue. He took his general manager's cost and he allocated 30% of it to the new buyer. Okay, great. I said, can I hire? So I looked at him and I said, listen, you have 1 general manager. If I have a facility, do I need 1 general manager? He said, yep. That's okay. So can I take a person and split them into 30%? How you can't, just because somebody's getting paid 100% to manage 2 locations, I'm still going to need someone to manage my location. So I have to pay someone that same 100%. So instead of 1 general manager for 2 locations, you have 1 general manager for each location. So that's an example of where the seller had a higher EBITDA than the buyer was going to have, because he was able to consolidate and use economies of scale to cut down on costs. But if you're doing a carve out, anytime you do a carve out, chances are your expenses and your costs are going to be higher as a carved out portion than they were on the consolidated portion. So a carve out is immediate concern to do a QFV on day 1, really, because your EBITDA numbers and your ST numbers will be vastly different on a carve out basis than they were on a consolidated basis. So we talked a lot about diligence and EBITDA and quality of earnings from an EBITDA perspective. I want to touch on net working capital just a little bit as well. Net working capital is one of those topics you can probably talk about for hours, and you guys have probably seen a lot about it, and you're going to learn a lot about it if you're new to the space or you're new to ETA. Net working capital probably causes, like I said, deferred revenue is one of the top 3 items of dead deals. Net working capital is number 2 or 1. It's the reason for that is sellers don't understand it. Sellers think they don't have to leave anything back. And buyers, sometimes they don't articulate it well in the LOI. They're not clear enough with what they need and what they want. And frankly, the buyers don't understand it. That happens a lot. And so every single time we do our QV, what we look at is, what is the net working capital on a cash-free, debt-free basis for this business? And we look at different years. We look at trailing 12 months. We look at trailing 3 months. We look at trailing 6 months. And we find a peg for the business that is most favorable to everybody involved. So buyer, seller. Basically, we're trying to get to what is fair for this business. Now, the risk you run into is a seller doesn't understand why they'll need to leave accounts receivable. A seller doesn't understand why they need to leave work in progress. A seller doesn't understand why they need to leave these things in the business. Because here's the thing, I think of it as gas for the car. If you're buying a business without working capital, it's like buying a car and you have no gas in it. You're gonna have to put that gas in it. And depending on the type of business you're in, that gas can be either very cheap or it can be multi-million dollar gas tank. So understanding that early on is crucial, and it's gonna be a massive deal killer if you don't get ahead of it. What we like to do in this situation is we figure out a normalized current asset schedule and a normalized current liability schedules adjusted for things that are non-operational and debt-like in nature, and we come to a peg. I saw a deal, and it was this year as well, where we did a deal, and the seller didn't think he needed to leave anything in working capital. He said, "Listen, I run this business, and I'll show you guys an example of a sim that we came across recently, where I said, listen, if I saw this sim on day 1, I would tell you this does not make any sense to me. And so anytime you look at a business and look at a deal, always make sure you're looking at what's the balance sheet and what's the working cap. So here's an example of a sim we saw this year. Like, if you look at it, like, what's wrong? Okay, so A, you ask yourself, what type of business are you in? This was a landscaping business. So it's like, okay, you run a landscaping business and a tree trimming business with 0 accounts receivable and 0 inventory. Okay, I've never seen a business in ETA in my life that has 0 in accounts receivable. Because if you have a $0 in accounts receivable, either you're not selling anything or you're the greatest collector of cash I've ever seen in my life. It's just frankly not the case. And it's same with liabilities. You're telling me the business has 0 liabilities. So anytime you see a balance sheet like this that's recasted, or they say this is the net working capital, they presented this and they said the net working capital of business is 0. You're not getting any AR, you're not getting anything. I said, okay, well, listen, how fast do your customers pay you? I looked at an invoice, I looked at bank statements. It was like 55 days on average, okay? A customer takes an average 55 days to pay. How many payroll runs do I have to pay in 55? That's almost 2 months. Let's say everyone gets paid semi-monthly. I have to run payroll 4 times. I have to pay for all my inventory, and I have to pay for all the services that I put, in order to conduct like the tree trimming business. I have to pay for the equipment, all that stuff. Before I see $1 in my pocket, I got to pay 4 payroll periods and the inventory. So what's that cost? Well, that's probably going to be a few $100,000, right? So that's an example where if you buy this business without working capital, I'm paying for the business, and then I'm paying $200,000 that I'm never going to see again in my life, because until I sell the business. Because once you invest in working capital, that money never comes back to you. It's always stuck in a cycle. And so unless you liquidate, you're never seeing that dollar again. So that's why when you buy a business, you need to make sure you're getting enough working capital. Or if you're not getting enough, you're getting something that's reasonable and close, or your SBA is financing your entire working capital and you're fully okay with it because you're buying the best business that you've come across and you really love it. So those are the only scenarios where I think you can walk away without getting great working capital. It's by definition a deal killer, because this is a few $100,000. I'm doing another deal right now. A business is $1.1 million in EBITDA. Their working capital need is $1.4 million. So imagine then they sold without a working capital peg and gave it 0. I'd be paying $1.4 million just to run that business. I'd have to put that into the business before I see $1. So really understanding the type of business you're paying for and what your working capital cycles are extremely important. And if you do a QV, they should be able to tell you that. They should be able to get you a peg for the number. If you're not doing a QV, I wouldn't recommend that. So I would recommend doing one and having someone on your team to figure this out for you. So net working capital is a massive deal killer. Every single time a business is growing, your net working capital need is going to increase. So for example, we saw a deal where they were selling the business on TTM EBITDA, but their net working capital peg was the average of the last 3 years. Okay, so you ask yourself, why are they doing that? Well, their sales have been doubling year over year. So is it fair to use a net working capital over an average of 3 years if your TTM is your highest revenue and your highest earning period? And the answer is no, right? It's every time a business is growing and increasing in size, your net working capital need increases your size, your accounts receivable increase, your timeline to get paid increases, the amount of inventory you need on hand increases. So anytime you're buying a heavy inventory business, it's even more important to make sure your net working capital is right, because inventory is an absolute cash flow and deal killer if not dealt with appropriately. And so understanding what your inventory is, what costs are going into your inventory, what your balance should look like versus what it does look like on the P&L, if they're expensing their inventory, if they're expensing freight, if they're expensing other costs associated with bringing it to readily available use. Ensuring you have someone who looks like that is going to be extremely important. So all of these stuff that we see here are kind of massive deal killers, and net working capital is one. So net working capital, QV adjustments are usually the 2 biggest areas where deals die from a EBITDA and from an SDE perspective. And then obviously you see some with margin compression sort of kill deals a little bit. work in progress is going to kill deals, but those are very niche depending on the business you're buying. If you're buying a home healthcare business, for example, there's going to be some things with billing and that you're going to want to look at, versus if you're buying a business where you're selling inventory, you're going to want to look at inventory more. Businesses that are in construction, you're going to want to look at payroll versus or W-2 versus your 1099s versus your superintendents. How much are they getting paid? Do they have an opportunity to steal away some of your business? And so these are some of the big deal killers, but there's so many other ways where sellers and brokers and parties that have different interests than you as the buyer can present their information to unfortunately put you in a bad position or to maximize their value as a seller or their value as a broker. So making sure you have someone on your team who's looking at these, digging into every single one, understanding them, and making sure that at the end of the day, they're counting SD, EBITDA, and their working capital treatments are correct and accurate is going to be, it's super valuable for you as a buyer. So I'm going to stop there and open the floor up for the next 10, 15 minutes for people to ask questions about deals they've looked at, anything that I've talked about, if they want to hear more horror stories, or if they want to ask about the ones I've talked about. I'm just going to open it up in general at this point here. Yeah, and Quinn has a question here.
Yeah, I was curious. I've run into working capital challenges on a deal recently where they're not wanting to include any on the basis that they're saying that's effectively them paying for their own business. And so I've tried to get them to understand that, no, it's like buying a car with needing a little bit of gas to get it home kind of level. So I'm curious as about how you think about determining a effective working capital number if they are driving that conversation pre-LOI to have a definitive working number identified, as opposed to being like, the right peg and we'll figure it out as due diligence continues.
Yeah, absolutely. So I think the challenge you're facing is unfortunately a challenge a lot of small business owners, buyers really face. It's getting the seller to understand it. So I think there's two things to ask there. The first is going to be, okay, well, if they don't want to leave working capital, what's the actual peg? And is it okay? Like, so for example, I've done deals where the buyer's been like, hey, Avnit, the working capital peg is 50 grand. If they don't want to leave it, fine, my SBA will finance it and we're fine. I really like the business. Versus if the answer is like 400K, then all of a sudden it's like, hey, Quinn, are you going to buy this business and then pay another 400K in working capital? Does that make sense to you? And you might say, no, that doesn't, because I'm already paying a multiple for the business. In my eyes, when you pay the multiple for the business, you're paying for the business as it is today, not the bare bones of the business. You're paying for everything it has, everything, the goodwill, the inventory, the trucks. That should be coming with the business and the valuation. And so really, I think it's a two-part question, right? It's what can you reasonably finance or want to finance from your SBA loan or from your other financings in a working capital, and is the business worth it for you to do that? Unfortunately, there's cases where we say the peg is this, the buyer's like, I agree, seller says no, and then we say we have to walk away because it's just crazy for us to pay you 4.3x on a business and then have to pay another $1 million in inventory, because then I'm paying 6x. And so it just doesn't make any sense to me. So I think it's, hopefully you have a good broker on that deal or somebody who's in the seller side to kind of coach them through that. Or B, hopefully it's just like, okay, the working capital need is only 30 grand. And once you do a QV, they say come back, it's only like 20, 30 grand. You're like, okay, I think that's enough and I can swing that. So those are sort of unfortunately the only options. And I know neither of them sound great. The seller's not open to negotiation, but I think that's the best path forward there.
Yeah, unfortunately, it's a broker who is also believing that working capital should not be included, and it's a sizable amount of working capital, over $1 million.
Yeah, and so I think that's a bit of a tough situation, because the only way that's justifiable is if you're getting a multiple that's significantly lower than market. Then you can say, oh, all right, I pay $1 million more. But if you're not getting a great multiple, I would not be super comfortable in that situation.
Thanks.
Yeah. I think Delanda has a question here.
Hi, it's Delnada.
Oh, Delanda, sorry. Yeah.
No worries. I have a question. So I'm working with this guy on a deal, and he sent me the deal, right? And he wants to be on the deal. And I don't know how that works. I don't know how that works with adding him, because he wants to what he wants me to like add him into like a payment, like it would go on the balance sheet for my payment to him. This is what he explained to me. I've never heard of this, so I was
Mhm.
wondering, do you have any advice for me regarding that?
Yeah. So I think typically when someone brings you a deal, I guess in which capacity are they acting? If they're acting in a broker capacity, I would say the seller has to
Mhm.
pay. If they're acting in a finding you and they have a relationship with you and they found this deal for you, it's pretty typical to pay finder's fees for something like that as a
Okay.
percentage of the deal price, which cascades based on enterprise value. Now, how you pay that, I don't know if your SBA is going to be okay to finance that or some. It basically will go into your deal costs as finder's fees. But it is reasonable, I think, if he found you a deal off market or found you something that you really like, to pay some sort of finder's fees based on not even a layman scale, because that's more publicly traded companies, but some sort of scale based on enterprise value for a percent or two that decreases as your enterprise value goes up. I think that's okay. But I think
Okay.
that should go into your deal costs as part of, you should anticipate paying that as part of your deal costs, and you might have to overfinance on the SBA and just hope and still make sure your cash flow and things make sense.
Okay. Yeah, no, he did not. So he's a guy that goes around looking for deals, not specifically for me, but just he goes around looking for deals, and he sent me something, and then he was discussing to me how he likes to get paid,
Yeah,
and he likes to get paid when the deal closes on the, like when we go to, I guess kind of like real estate. Like I used to be a real
yeah,
estate agent, so when the deal closed, I got a check, right? And so I was like, huh, this is really interesting because
yeah.
like they don't have a license, or he don't like
Yeah, I think
I
it's typically a finder's fee agreement that you'd have with them. Just if he finds you
okay.
business, you pay a percentage on. I wouldn't pay a crazy percentage. It's not like a real estate commission. So I'd say search up kind of like a layman scale, but for search up finder's fees for lower mid market deals. And I can send you something on it too. It's not, and that should kind of be a range of percentages to look at there.
Yeah, I think he's saying 3%, but it's like a $5 million business. I think that's
Yeah,
I don't
it shouldn't be a flat three, is what I will say. It should be a like, it scales based on enterprise value. So the first million is maybe three, and then or four, maybe more, and then as you go up from two to three, three to four, it should scale.
okay. Oh, great. See, I didn't even know that. Okay.
There you go.
Thank you so much.
Yeah, of
Thank you.
course.
Oh, and can you, whatever you said you was going to send me, can you send me that as well?
Sure. Yeah, I'll send it to maybe Andy, and he can flip it off to you.
Okay. Thank you.
All right.
Awesome.
Well, Avnit, I really appreciate the candor as always. And yeah, feel free to send me whatever we would like to share to our accelerators, and I'll
Yeah.
definitely share it with them as well. And for everyone else, if you have any deal that's under LOI or heading there soon, please bring questions early. Feel free to send me or Nathan or maybe Rich. And if you'd like to reach out to Avnit, we have his contact details on our Google document that I've shared that contains all information about our trusted partner. We have Avnit and Javier as well. You'll meet him in one of our AP calls as well in the future. But for now, is there anyone that has any questions for Avnit?
Yeah, I got one more.
Sure.
Oh,
I'm
sure.
also looking at a deal where I'm having a really hard time getting getting clear on the appropriate multiple for it.
Yeah.
It's not in the typical industries that we've been looking at from an acquirer perspective, and I'm finding really radically different data points on the valid multiples for that kind of industry. So I was just curious if you have any guidance on what to do or how to look at proceeding in something like that.
Yeah, I think it's tough when you get to niche industry focused to find a great comparable multiples. And so what I would say is try to assess the cash flow and apply a reasonable multiple based off of the cash flow you're seeing in the business. So for example, if it's $1 million, okay, maybe 6x is crazy, maybe 3 is a little bit low. Okay, maybe 4 starts to have a bit more of a conversation. And then the second thing is, if you're having even more trouble, I would say assess the net asset value of the business as well, right? Like, are there a lot of trucks coming with the business? Is there a lot of equipment coming with the business, right? Because, okay, if there is, then you could justify a little bit on a higher valuation because your goodwill decreases because your tangible assets are higher. If it's a pure e-commerce play, for example, it's not coming with any inventory or very little inventory, for example, and no assets, no trucks, no equipment, well, then your goodwill is basically most of your purchase price. And so you have to ask yourself, what's the goodwill dollar you're willing to pay for a business like this in the brand name? Is it $1 million? Okay, maybe it's probably not 6. And so that's where, if you've got a business, or then obviously the industry matters as well. And I know if it's tough to find data, you just have to kind of, I think, assess it from a cash flow, assess it from a growth or decline industry perspective, and then assess it from a net asset value perspective.
Thanks.
Delnada, do you still have a question?
Oh no, I think I just didn't lower my hand. Let me do that. Thank you.
Totally
Thanks for
okay.
checking.
So anyway, if we don't have any further questions for now, just feel free to send me your message or questions. We can ask help from Avnit, or you can directly reach out to him. And just a reminder again, no call on December 22nd, but I do hope everyone enjoys their holidays.
All right. Thanks, everyone.
Thanks
Amy.
everyone.
Thanks,
Again,
Avnit.
Thank you.
Thank you.